JK Lending is a fictional company that issues loans for home ownership. In this demonstration, we will follow 3 employees as they leverage business process management and business intelligence systems to improve their loan approval processes and resolve performance problems. Arvind is the loan director with responsibility for the performance of the loan portfolio. Rick is a business analyst who develops, models, and simulates loan processes. And Larry is a loan officer who makes individual lending decisions. Our demonstration begins with Arvind, the loan director. He has received an alert on his desktop. The alert shows that loan processing time is exceeding service level agreements. He logs into his business space to investigate. His dashboard gives him a complete, high-level view of JK Lending's loan processes. He first looks at loan processing volume and sees that it is lower than expected across all regions. He then looks at his key performance indicator gauges. The key performance indicators show that loan processing and average approval times are well over target values. Unfortunately, this is not new. Arvind has been attempting to correct the problem for some time. In the past, he has tried to address the problem by redistributing work across teams. As the problem persists, Arvind knows he needs a better solution. He goes to his business reports to look for additional insight. Tags in the loan process are used to fetch relevant Cognos business intelligence reports that provide insight into key aspects of the business. Arvind runs several reports that combine information from the data warehouse with real-time data from the process and business activity monitoring databases. Arvind studies the approval and default rates across all risk groups. He sees that the average loan approval time is virtually the same for all risk groups and loan types. Looking at customer satisfaction scores, he sees that customers are becoming less satisfied with responsiveness during the loan process. Looking further down the report, he sees that the percentages of loans approved are all within target. This confirms that the problem is with loan processing time. Looking back at the risk groups, Arvind wonders what would happen if the company pre-approved the low-risk group, freeing up the loan officers to work on more complicated applications. He shares the reports with Rick, a business analyst, and asks him to look into re-engineering the approval process. Now we will follow Rick as he logs into his business space to look at the reports Arvind has shared with him. Rick looks through the reports, noting the loan approval times and approval rates, and comes to the same conclusion as Arvind. The issue lies with loan processing time. Rick reviews the current approval process and opens WebSphere Business Modeler to implement some changes. Based on what he sees, Rick adds a new business rule that allows some loans to be automatically processed. The rule checks the loan amount and the applicant's credit score. For example, if a loan amount is less than $30,000 and the applicant's credit score is higher than 650, the loan would be automatically approved. After making the change, Rick runs a number of simulations using historical process data to ensure that the changes will have an effect on loan processing time. The simulation results are promising. Each simulation shows a drop in loan processing time and an increase in volume. Rick is satisfied with the results and hands the new model off to IT for deployment. 2 months later, we revisit Arvind, the loan director. He logs into his business space to look at the performance of the loan processes. He first takes a look at the processing volume, and he's happy to see that the process changes have resulted in higher processing volumes across the board. Scrolling down, he sees that processing times have also improved significantly and are now all within target values. Unfortunately, everything is not well. Arvind has just received an alert from Cognos showing that loan default rates have exceeded threshold values. Arvind pulls up the relevant reports to investigate the problem. Looking at the reports, he sees that loan defaults have increased for some loan types. He also notices that loans processed automatically have a much higher default rate than those processed by loan officers. Customer satisfaction, however, has improved since the loan approval process was modified. Arvind forwards the alert to Rick, the business analyst. Now we follow Rick as he logs into his business space to look into the alert that Arvind has sent him. Rick views the reports and quickly sees the higher default rate associated with the automatically processed loans. Rick decides to change the automatic approval rule to send borderline cases, where the credit score is between 600 and 700, to loan officers for approval. Only applicants with perfect payment histories and credit scores above 700 will be automatically approved. To improve the loan officer's decisions and ensure standards, Rick augments the business process with applicant account and payment history reports. These reports will be routed to the loan officers along with the loan applications. Now we will follow Larry, a loan officer, as he logs into his business space. On his dashboard, he sees a list of loans that require his attention. Additional views on the dashboard show current mortgage rates and promotions. From his list, Larry selects a loan application and opens it to work on the approval. The task form contains processes data about the loan application. It also contains filtered Cognos reports, detailing the applicant's related accounts and transaction summaries. With all of this information, Larry can make an informed decision about the loan. In this case, he chooses to reject the application. After several months have passed, we watch Rick as he logs into his business space to see how the new business rules are performing. He runs a report to compare current performance with previous quarters. He wants to make sure everything is running smoothly. The reports show that the new rules have made a significant difference. The default rates are now within acceptable limits across all loan types. Through this demonstration, we've seen one example of how business process management and business intelligence can work together to optimize business processes. Using these two systems, JK Lending was able to better understand the problems with their loan approval process. As a result, the company could take swift action to improve customer satisfaction and reduce default rates.